Welcome back, everyone, to Vox Markets. My name is Paul, and I'm delighted again to be able to speak to Jamie Constable, seen as one of the UK's smartest capital markets experts. So, welcome back, Jamie.
Hi, Paul. Welcome. Good to see you again.
Yeah, well, last Friday's US jobs report came in lot more stronger than people expected, with the 10-year Treasury now ticking up to 1.3%. But going forward, what happens next with the markets? Is it sort of up, down, or shake it all around?
Well, looking at treasuries, I mean, where do they go next? Well, we had that massive fall down and everyone was kind of scratching their heads, including me, as to why on earth they fell. I think maybe the market just got too bearish. The market moved back up and all those shorts had to close. I think, as you say, the jobs market was much better than expected. I think I'll switch from looking at jobs to vacancies. Vacancies are off the scale. I mean, It's not just the US, the UK. There are loads of jobs out there. And at the moment, people aren't really looking to, I mean, there's still, in the US, you still got the unemployment benefits, which are just coming to the end. You still got furlough in the UK, with about 4% of the people now still left on furlough. But there's plenty of jobs for them to do. And people are talking about a changing dynamic of the jobs market. You know, is the labour pool as big as it was? Probably not. So I think that's all very bullish for growth, I think, really.
What about inflation? Because if you've got more vacancies than you have on people looking for jobs, that means salaries are going up. And you saw that in the payrolls number. It was up 4%. But actually, that could just be the start of this sort of like, trend to increase people's, annual salaries.
Yeah, and everyone said it was going to fall because all these lowly paid jobs were going to come back in restaurants and leisure, etc. And it didn't, did it? As you say, It went up. So that's confounded everyone. And if you look at US Fortune 500 companies, do you remember Biden was saying he wanted to bring in a $15 minimum wage? And it didn't make it because he couldn't get that through the Senate. But actually, a lot of those companies have actually done it anyway. Wage inflation is there as well. So what does that mean for US inflation, and what does it mean for bond
We've got
rates?
the CPI today. So what's your view, first of all, on your CPI? Because I think that the market's saying Wall Street are sort of anticipating a July print of 5.3%, which is about the same as where it was last month, but significantly higher than the Fed's target, 2%.
Well, they've got this symmetrical target now, haven't they? But if it's 2 and it's 5, that's quite a long way the other way. That means it's symmetrical. It needs to go to -1 then, doesn't it? If you're going to be symmetrical, it's going to stay higher for longer. Looking into next year, I think it'll probably be back towards the 2% by the end of next year.
Right.
Now, that is it. Obviously, they'll be happy with that. Bond yields will be up on that. I was saying that we expect 2% by the end of this year. I think they have to move back up again. You can't have rates where they are, inflation where it is, and staying higher for longer. And
that's because of the real yield argument.
Yeah, exactly. Because the real, inflation linked bonds are huge negative yields at the moment.
Yes.
I think something has to give. We've talked about it before. The stimulus accelerator is foot to the floor still. You've just had the $1 trillion infrastructure bill on top as well. And we all know that construction has the biggest multiplier effect into an economy. So if they start building bridges, start building roads, that's more people back in work again. So US-wise, growth. Just on the inflation, though, before we move off that one, Jamie, you're saying 2% by the end of 2022. We've got break-even inflation rates of CPI in the US of roughly around about 2.2, 2.3. I mean, so you reckon it's going to be lower than what the market? I mean, I can only see it higher than what the market reckons, to be perfectly honest. It's a really difficult picture at the moment, because I think in the short term, you're going to have a bit of a depressant effect, maybe, or could go either way with what's happening in Asia at the moment with the Delta pandemic, because that's going to take something out. But of course, basic economics that tells you if supply from Asia falls and demand stays high, prices go one way, don't they? And that's up. So it could stay higher than that. It could be 3. Well, if that's the case, they're going to have to raise interest rates. So they're going to have to, and of course, before they can do that, they're going to have to taper. They've shown no sign of tapering yet.
So what I'm going to ask you then, a cheeky question: when are we going to start tapering, and when are we going to push the button on interest rates in the US?
In the US, well, my view is they should have already started tapering, so it's got to be imminent. I mean, they've got to start soon. We get another jobs print by like we had last week. then they're going to have to start. So before the end of this year, you have to start tapering.
Announce it or actually start it, because Wall Street are expecting January.
Yeah, I think you have to start. As soon as you announced it, you've effectively started it anyway, haven't you? Let's be honest. As soon as it's announced, it started. Canada's started, Australia's started. New Zealand, you're looking at interest rate rises next year, half one next year. I've said before, New Zealand often leads the world economy. That's kind of showing you what's going to happen. So you'd expect interest rate rises in the US next year.
So where do you reckon that's the biggest driver at the start of the year was the 10-year Treasury. We saw that huge rotation from effectively expensive tech into, reopening trade stocks.
Yeah.
And if we're going to say the yield is going up from 1.3% to how much are you saying by the end of this year?
1.75. I actually think it's got to get back up to that. Yeah.
So what's that going to do to the equities then? And we're going to see that re-rotation because value stocks have actually been beaten over the last 3 months.
I'm very bullish still on those value stocks and the recovery stocks and domestics. I think people are going to be surprised. We talk about inflation being higher for longer. I think growth is going to be higher for longer as well. And that's what's going to surprise people. Look at the earnings season you just had in the US. 85% plus of S&P 500 companies beat expectations. They always beat expectations because they.
But that's enormous, isn't it? It's unprecedented.
Oh, it's never been that high. Now look at the UK results season. We've started it, but it'll really ramp up in terms of small caps as well into September. You're going to be surprised at how strong some of these numbers are because management are understandably quite being conservative and cautious at the moment. You're going to be surprised how big the bounce back is. I think what you do need to take big care, though, is pricing power, as we talked about before, because we're starting to see a few companies where margins are being squeezed. Now, some of them it's just a question of timing. They will get the price rises through. I mean, UK inflation, we're talking about it being 4%, as 4% at the end of this year, back to around 2.5% the end of next. So you've got inflation. You need and PPI, obviously, producer prices. They've got to pass this inflation on to protect their margins. So that's your risk factor on stocks. Also, what I think we're going to see on stocks, looking at the UK market, the differentiation between the good and the bad is going to happen. It's been everything going up now. The ones that deliver will be rewarded with the upgrades and everything. The ones that disappoint, they see the margin squeeze and they disappoint on numbers, they'll go down and they won't bounce, I think, is the key now, which is much better for stock pickers. That's the key. It just becomes a stock pickers market, which is what you and I like. Yeah, no, well, you're talking my tune here. So just let's run through some actual stocks which could benefit. And I know you've got one on this, or a couple on the sort of online area, sort of in e-commerce and stuff like that. Do you want to take us through that? I think you want to start with Boohoo. Well, Boohoo, I mean, God, where can you start? I mean, it's been beaten to a pulp basically of late, hasn't it? I mean, it doesn't really matter what comes out. Everything's negative, whether it's a US court case, whether it's Leicester and the factories there, whether it's a Chinese competitor in Shein. I mean, it's been hammered. So is there any more bad news that can go into the price? I think we would question that. All the bad news is in there, as we can see now. Do they have the best standards now and checks in place for their supply base? You have to believe they have. They've had a barrister in there looking at it all. They've done huge Brian work. Leveson, isn't it? Exactly. They've done huge work on it. Will there still be problems? Of course there will be. The textile industry, it's always going to have these problems, but they are doing everything they can. I mean, if you're going to hit them, what about the other suppliers? And if you want to hit anyone, Shein, the Chinese business, I'm sure they're very above board with their kind of supply. Yeah, right. But it's interesting. The consumer would rather buy these. The consumer, when we had this all started, did Boohoo see any hit to their sales? No. Yeah. The consumer's happy because they want the product and they want the price. So I think Boohoo now, it's on 14 times EV/EBITDA, falling to 11 next year. Yeah. I mean, that is giveaway. No, I agree with it. Given the growth trajectory of this business and the value, I mean, I think the PEG ratio is less than 1, and it seems to optically fall into the super durable, high growth, but surprisingly low valuation camp. And there aren't that many of them around. And I'm with you. No. It looks extremely attractive investment over the long term, particularly if they're now turning into best in class on their supply chain. Exactly. I think no one's given them any credit for what they've done yet. Well, the market hasn't given them any credit for what they've done. And they will get it in time. And numbers will come through showing they're performing, they're still trading well. Look at the weather at the moment and the summer and the staycation. They're going to have done well out of that. I'm sure they're going to have done well. So I think down here, tuck them away and it will come back.
What about one of their biggest rivals, ASOS? Because they're on a similar sort of valuation. They're
higher. Yeah, they're actually on a higher rating now. And it always used to be the other way around. Personally, I'm not so much a fan of ASOS.
Is that well, you don't shop there, Jamie? Is that it?
I'm a little bit too old for them, I'm afraid. I think the trousers are a bit too tight for me nowadays. But the difference between Boohoo and ASOS are this: Boohoo own all their brands. They are in control of it. They do their test and repeat strategy. So actually thinking about environmental, that's environmentally friendly, test and repeat. You don't have loads of stocks of stuff and then have to discount it all because you're producing to sell. But anyway, ASOS, knocking on a half of their sales are other people's brands. Right. Now, the problem is with that, you're not in control of price because the consumer can go onto the internet and they can find it somewhere else, whether it's Zalando or whoever it might be, they can go and find it somewhere else. Now, I'd much rather be in the stock that's in control of its destiny and its brands than one that's not. Now, don't get me wrong, ASOS is a strong company. Online's a great place to be. But now, in terms of valuation, where would I put my money? Boohoo every time. Yeah. So Boohoo over ASOS.
Yeah, and with the M&A theme, I mean, because I think the whole UK online e-commerce sort of like complex is significantly undervalued compared to its US or even its European things. I mean, Zalando is about 2 or 3 times more expensive on a ratings basis. I mean, I know it would be always difficult to sort of buy the sort of family shares out, but frankly, they must be getting overseas interest, you'd have thought, because of this, effectively. It's actually a really good brand. I mean, what I've seen is that actually, because the children use it a lot or youngsters use it a lot, it sort of encourages adults to sort of like have their past again and sort of like try it out. So they've
got the other brands now, haven't they? They've got the other brands.
You get that endorser effect.
Leadership. So you've got other brands on there as well now. So yeah, I think down here, I think the storm that's surrounding it will fade. You can't expect companies to be the law enforcer for the government and the inspectors on the factories. They've got to go in and do it. They're doing everything they can. If they're behind the scenes asking their employees to pay back what they're paying them, well, how on earth can Boohoo know that's happening? So I think Boohoo definitely a buy down here. Yeah.
And then another one on the sort of like a bit further down the food chain is DX Group. I know has sort of caught your eye, hasn't it? Which is sort of like e-commerce deliveries. It basically, I don't know who they compete against. Presumably people like the Royal Mail or other delivery couriers and freight export operators.
Yeah, DX is basically a logistics business. It had been a complete and utter disaster. It was on the stock market before it went private. It came back to the stock market. Basically, back in a new management team came in back end of 2017. They live, and the chief exec of that lives and breathes logistics. He is a logistics man.
It's Lloyd Dunn, is it? Lloyd Dunn, yeah.
And that is what's made the difference here. He has gone in and he has incentivized and invigorated the whole team. Everyone wants to work for him. That's great. They all want to work for him. Margins are going up. Margins are going to continue to go up. Profit pre-tax forecasts for this year have gone up from 3 million at the beginning of the year consensus to 11.7 now. That shows you what's going on. The last update they had was actually on a red day in the market. More strict trading ahead of expectation. The price didn't move. Didn't move. Now, if you look at ratings, it's trading on the same rating for this year as a lot of the other logistics companies. But looking through to next year, this is a recovery stock. Margins are going up. It's on a significant discount looking on next year's rating. So I think you've got a great story here. Management, if they get this price to £1, all their kind of incentive schemes will.
It's 33p at the moment, isn't it?
I think there's plenty of upside to go for.
Yeah, okay, yeah, I understood, yeah.
So we had a very good call with them. This is
What are the USPs, Jamie? What are the USPs? Because I did read.
Well, they do a lot of two-man delivery. So that's the difficult thing to get right.
That's awkward to handle freight, is it?
Yeah, exactly. Yeah.
And what's an example of an awkward to handle? Is it like a fridge or something like that, or is it sort of like furniture? Okay, yeah.
Garden furniture.
Yeah, okay.
Let's look at it. It's all the things that the 200 billion of the consumers have got savings are spending their money on as they move house and everything. So you've got a great outlook for that going forward, continuing that. They also have DX Exchange, which is the document exchange, which is where the lawyers use and all that, and the government use. Now, that is still a bit depressed because obviously they're not all back in the office yet. But I think come September, there's going to be, we're seeing it here. People are all coming back now. So that will then, you've got recovery potential from that as well. So you've got a great story here of secular growth and recovery potential.
And then I saw on the valuation, it's on about 15 times next year's PE, but the PEG, and that's probably on sort of like undercooked analyst estimates as we talked about. But the PEG ratio is actually less than 0.5.
Yeah, it's a great recovery story. I think we highlighted Wincanton as being one before, and that's done extremely well. I would say it's the next one to follow on from that again. It's already recovered. It's already recovered from its lows, but there's loads more to go for here. So we like that one as well.
Yeah, and then the final one on the value basket is something which is like ultra sort of like, upside opportunity in terms of is Galliford Try, which seems to be, it's sort of a market cap of 180 million, but it's got over 160 million of average cash. It's got a PPI portfolio on top, which means that essentially the whole of the business is almost for free.
Yeah.
You look at the maths.
Totally you hit the nail on the head with the numbers there. Contractors, the market loves to hate. And we know why. You've had Carillion, Interserve, even Costain, which was the one everyone loved, quarter cold on some contracts. But this stock is so cheap. It's trading on less. It was less than cash. It's rallied a little bit of late, but around cash. And you got the PPI portfolio, as you correctly say. And we've talked about it before. What's happening on infrastructure? I just said you've had the infrastructure bill in the US, but that's just an indication because that's not going to not help Galliford Try. But we've got the same in the UK. Capacity has been taken out of the industry. The commercial property companies are now investing. You saw Derwent London yesterday buying 2 assets in London. They're going to do a 250,000 square foot development in London. People are building now on that side because you need the properties in 2 to 3 years, and you need modern properties. But it goes through the whole gamut there. Galliford is utilities and infrastructure, all that kind of work, water. We all know it needs to be upgraded. So
renewables, wind farms, Hinkley Point, HS2, you name it. The list is as long as your arm, isn't it?
Exactly. And there's less capacity now than was before. Yeah. Because obviously we just talked about companies that disappeared from the market. And should these businesses be valued on 20 times PEs? Of course they shouldn't. No. They're never going to trade on those PEs, but should they trade at cash? And it is their cash. That is their cash. Yeah. It's not contracting cash that it's just washing through the books. It is their cash.
That was acquired. That was obtained when they sold Linden Homes, wasn't it? That was the disposal proceeds. Yeah.
So it's just a very cheap stock that's worth pointing out.
I do notice you and Gervais Williams have the same view because he's been sort of mopping up the shares. Sort of
has he? Oh, right,
over the last. The one concern to investors going forward is contract discipline. Now, if you've got wages and cost inflation coming up, how flexible is it going to be to actually increase the top line? Because margins are quite slim. Is that going to depress them, or is there actually a way of renegotiating and making sure that you do make at least a margin on these contracts going forward?
Yeah, a large chunk of their contracts now are open book, or cost plus as they call it. So you take the cost, you put them through, and you add the margin on. So that's a large chunk. There will be elements of contracts. What Galliford have done is they limit the size of the contracts they're doing. There will always be contracts where they don't quite go to plan, the costs go up or whatever. The idea is that you don't make a loss on those. And that's what these businesses are aiming for. Don't make a loss on those. Don't take on, where did they all catch cold last time? These waste to heat contracts, which are just an absolute nightmare. Yeah. You don't want to go, if anyone goes anywhere near one of those, run a mile because...
those are incinerators, aren't they?
Yeah, exactly. They all caught a cold on those. So that's the aim of their doing. And they will have ones where they don't make so much money, but they'll have ones where they make more money. But when a stock is as cheap as that is, you have to point it out because I mean the others. If you look at their peers, their share prices are starting to rally quite nicely now. So this just seems a standout stock that just looks too cheap.
Lots of self-help there, isn't there, as well? I think.
Yeah.
And again, the PEG ratio is 0.4, so it's hugely cheap, no doubt about it. Yeah. All right, brilliant. Well, thanks very much, Jamie, for those excellent stock tips. Look, you've whet our appetite now. Looking forward to the next three in September.
Okay, looking forward to it.
Take care.
Cheers. Bye.